everybody, and welcome to The Real Deal with Rob and Leo, where you get the facts straight up with Southern California real estate news and information. I'm your host, President of Crown Group Real Estate, and as always, Rob Rivera, Senior Mortgage Consultant with International City Mortgage. Thanks for being here today, Robert.
Thanks for having me, Leo. How you doing today?
I'm doing well. So a lot of interesting subjects that we're going to cover, mostly the mortgage outlook of 2014, what's happening now in the finance world as far as Southern California mortgages, and what exciting news could be coming around the corner. So why don't you tell us a little bit more about what we're experiencing right now in the month of February?
Sure. First of all, let me thank you for having me on. As you already know, starting on January 10th of 2014, there's been new rules that have come into the market, and they're calling them the qualified mortgages, or a qualified mortgage. And essentially what they are, there are a set of rules that every lender must follow to ensure that people that are borrowing money to buy a home can actually repay that money.
So hold on. The money they borrowed, they want to ensure that they can actually pay it back.
Exactly. That's all it is. It's essentially just a little extra precautions to make sure that you have the right income, the right employment, and the right credit. Now, like you said, sounds very basic. But as we all know, thanks to the 2008 housing bubble and the crash, not always do banks verify this information. So these new rules are set into place to make sure that borrowers can actually repay the loans. Now, with anything else, like everything else in life, there's a good side and a bad side to everything. For the consumer, there's a couple of benefits that the qualified mortgages brings. For example, there is a maximum of 3% that can be charged to the borrower.
Which is a big hit to your guys' pocket.
It's a big hit to our pocket, but again, it's a benefit to the borrower. We want to make sure the borrowers are not being raped over lenders' fees. Secondary, there's no more interest-only loans. So this time around, if you're buying a house, you send your mortgage payment, you're going to make sure that that payment is going to both your principal and your interest, so you're actually paying off your debt, which again is a good thing to the borrower. And third but not least, there are no balloon payments. So that means if you want to refinance prior to 30 years, go ahead. There's going to be no balloon payments on these new mortgages.
But hold on, you mentioned one thing, and I might be getting ahead of you, but you mentioned caution. Now, are they being overcautious with this?
Well, here's the other point I was going to make. Your debt-to-income ratio has dropped from a 50% down to a 43%. Now, both me and you are familiar with this term, but to our viewers out there who've never bought a home, it used to be that you had a maximum debt-to-income of 50%. What that means is up to 50% of your income can be used to buy a house and for your monthly bills. That number has dropped from 50% down to 43%. So in other words, or in basic English, you've lost 7% of your purchasing power. And that can greatly affect the real estate market, because now that means less borrowers out there who are qualified for a loan, and the ones that are on the market now qualify for 7% less, which is going to affect prices in real estate.
Yeah, and I'm thinking about the, that side of the token exactly. What about the sellers out there? Like I said earlier, we just came out of one of the craziest real estate markets that we've ever experienced, where people would put a house in the market and within a couple of days you'd have a bidding war. And what that caused is prices to just skyrocket. I mean, we had a 22% modest growth in real estate prices, and that's modest because in our area where we focus on the Riverside, San Bernardino, Inland Empire area, we increased a growth of up to 29% in real estate prices. But
let me step in there, Leo, because if we really look at the real estate market over the last, let's say, 2 years, both you and I know that the rise in real estate has really been spearheaded by a lot of hedge funds who came in, bought a bunch of inventory that was up for sale,
and put it up for rent.
And then put it up for rent, and now they're just sitting there collecting rent.
Which makes some of these hedge funds some of the biggest landlords that have ever existed.
Exactly. So you have these hedge funds who pretty much came in and bought all this property for dirt cheap. They rehabbed them. Now they have renters in there. Now they're just collecting rent. So, when I'm looking at the news, and I'm looking at the unemployment numbers, and I'm looking at the recovery, about a month ago I called you and I said, hey, Leo, they're going to have to do something with the guidelines, or you're going to see the real estate market come to a halt, which, is not good for the economy. And that's when I told you, I think they're going to bring subprime back. Now, you literally almost hung up the phone on me, and I understand.
Yeah, so you're crazy.
Trust me, I almost literally hung up the phone on myself. But I was stuck on that side of the phone, so I couldn't do it. But, the reality is...
It's a crazy thought.
It's a crazy thought, you know, to say that they would bring subprime mortgages back. But let's be honest. The economy isn't doing too well. We're still trying to recover from the biggest recession in history since the early 30s.
Yeah.
And unless they do something to increase the demand for real estate or the availability of credit, then you're going to have real estate prices drop. That is not me being a conspiracy theorist or anything like that. It's just basic economy 101. There must be a supply and there must be a demand. And if there's a demand that's growing but there's no supply of income to facilitate that demand, then real estate prices are going to have to drop. So I don't know.
Which would not be a good thing in today's
Which
economy.
would not be a good thing in the economy because, you know, everything else is going to fall. If you have real estate prices drop, then you're going to have people being laid off because those
It's
you know,
chain reaction.
It's a domino effect.
I think everybody knows the moral of that story. I think unless you were born in 2008, you lived it. So, which let's fast forward soon. A month ago you were crazy. Now you're a prophet. Because interestingly enough, a couple of days ago, you actually texted me the link to the article that said, is Wells Fargo edging back into subprime mortgages? Which we know that they've been performing good with the subprime auto loans that they picked up. For those of you that want to read the article, we've included a link on it right here, so you can go check it out for yourself and make the decision on your own on what's to come. But also, just yesterday as well, I got another email from the National Association of Realtors, and in there was a link to a story that said, is subprime making a comeback? Now, here is a link as well to that story if you guys like to read it. If not, let me give you a brief summary. Basically says that as of last year, there has already been some lenders implementing some sort of subprime back. If you guys want to know the details, you can check it out here. But for the sake of time, I think that we won't get into too much. So with that being said, if you want to subscribe to our channel, here's the link. There's going to be a lot of good information that is going to be coming out regarding subprime mortgages. And you guys are going to want to stay on top of that, especially if you're looking at buying, if you're looking to sell, or if you have anything to do with some sort of the real estate market. It's good information to stay on top of, guys. So thank you for watching this edition of The Real Deal with Rob and Leo, and we'll check you guys out next time. Take care.